you're interested in how to grow, scale, and build your property portfolio, this information will arm you to make better decisions. Have you ever wondered what a subtle little change, like getting a credit card, does to your borrowing power and your ability to buy property? In 10 minutes or less, I'm going to go through 8 changes that impact your borrowing power. I'm going to go through your credit card positions, what help debts do, what an increase in your salary does, what an increase in your rental income does, what increasing your expenses does to your borrowing power, what interest-only loans do, what the impact of a car lease is, and finally, I'm going to round it off with what impact does having a baby have on your borrowing power. Hi, I'm Reedham Syed, founder of Confidence Finance and 6 times top 100 mortgage broker here in Australia. One little explainer to all of this. Banks calculate your borrowing power by getting your income, subtracting your expenses, and whatever's left over every month is how much they can lend to you. The more money you have left over, the more money they will lend to you. So all of these calculations that I'm about to go through now, they're based off changing your income or your expenses because they change the amount of leftover money that you have, and that is the key number that banks use. It's called your net monthly surplus. So anything changing your income up or down will also change your borrowing power. So number 1, credit cards. A $10,000 credit card will reduce your borrowing power by about $50,000. In fact, this is the most common one we see. We see borrowers all across Australia, particularly in Sydney, cutting up those credit cards whenever they go and get a loan. That tells you something. You can use a credit card if you want to. If you like points, you can go and use it for that purpose. But when you go apply for a loan to go buy a property, especially a home to live in, you often need to chop them up and start again. It's because banks use your credit limit when working out how much they lend to you. If you have a $10,000 credit limit, they're actually taking 3.6% of that as the monthly expense that they put into your lending calculations. That means you've added a $360 monthly expense to your borrowing power calculations that doesn't actually exist. You're not actually paying $360 in interest on the credit card. Whether you are or not doesn't actually matter. They're going to take it anyway. They base it off the limits you have. So what you can do as a quick little hack is reduce your limits down to as low as possible or cut up the credit card in the first place and boost your borrowing power that way. This is the most common technique that we use to boost people's borrowing power. Very easy to do. Secondly, help debts. So if you earn $160,000 plus, you're going to provide 10% of your income back to the government to repay your student debt. The amount of income you earn is what is driving your repayment amount. This is different to other debts. It doesn't matter how much money you actually owe. You can owe $1,000 to the government or $200,000. The amount of money that you are repaying to the government is all tied to your income, not the balance of debt that you have itself. So the greater your income, the greater the percentage repayment that you have. I'll put in a little table from the tax office here so you can see what repayment you have. This will reduce your borrowing power by different amounts. Giving you a few different examples, a $75,000 income, salary income, will reduce your borrowing power by about $30,000 if you have a help debt. Now, if you have a $200,000 income, you'll have a $250,000 reduction in your borrowing power. Quite the difference. It all scales with the income that you actually earn and the impact it has on your borrowing power. We find with higher income borrowers, it often makes sense to repay those help debts as quickly as possible, especially when you're trying to go buy a home. It is a really big drag for those particular borrowers. For lower income borrowers, perhaps it's actually better to keep that help debt if you really can't afford to repay it and it reduces the amount of money you have available for a deposit. You may want to keep it and just work with your smaller borrowing amounts. It can be a little bit of a trade-off, so when you're working with someone, be sure to ask them the question, what impact does my help debt have on my individual borrowing power and how does it change my budget? Number 3, what does a $10,000 pay rise do to your borrowing power? A pay rise has about a 7.5 times impact on your borrowing power. So a $10,000 pay rise will give you a $75,000 boost. Meanwhile, actually earning salary and working out what salary you actually have, that gives you about a 5 times multiple on your borrowing power. The reason is your first bit of salary, your first $50,000, $60,000, that goes to making expense payments. You know, just to live, breathe, pay for food, shelter, everything you need. That's from your initial salary amount. Well, an increase on your salary, technically you get to do what you want with that money. That's leftover money coming into your pocket, and you can choose to buy property with that increased amount, and that's why it has a 7.5 times multiple rather than that 5 times multiple. There's no additional expenses attached to increasing your income a little bit most of the time, and that's why it has a 7.5 times impact. If you have any questions or want me to run a different scenario, drop a comment below and I'll be more than happy to run through a different situation for you. Rental income has about a 5 times impact. It's a little bit lower because banks shade rental income at around 80 to 90% of the total income you actually receive. So if you get $100 a week, the bank is going to take roughly $80 a week, and that means you get about a 5 times boost per dollar of rental income you get. $10,000 increase in your rental income, $200 a week, that equates to a $50,000 boost to your borrowing power. Bear that in mind when choosing what type of property investment you're looking for. Increasing the yield on the property investment you have will increase your borrowing power and can help you buy at a slightly different budget if you can get a higher yield. Number 5, we've got expenses. So if you're operating above the minimum expense levels that banks take, if you go and increase your expenses by $100 a week, you're going to have a $60,000 decrease to your borrowing power. It's about a 12 times impact. It's quite nasty. This is because expenses are paid for from after-tax dollars. Gross salary increases, well, you pay tax on that. Expenses, that is money that you pay for from after-tax dollars. That's why it has a much bigger impact on your borrowing power than increasing your salary. Interest-only loans. When you go and apply for an interest-only loan, what the bank does is instead of assessing your ability to repay that loan over 30 years, if you have a 5-year interest-only period, they'll assess your ability to repay it over 25 years instead. This pushes up the expense level a bank takes, and that reduces your borrowing power. A 5-year interest-only period on a $500,000 loan reduces your borrowing power by about $35,000. Number 7, car leases. Car leases can be very, very dangerous to your borrowing power. It's because they incorporate all of the expense items that you have, all the running costs, fuel, maintenance, things like that, insurance. They incorporate it into the monthly car lease expense payment that you actually have. And it goes outside the bank's minimum expense payments, which include some of that in normal circumstances. So if you don't have a car lease, things like those maintenance and those fuel bills, they'll be included in your minimum expenses that the banks take. But if you do have a car lease, you're going to have it included in the car lease payment that comes out of your bank account, and that's why the bank is going to take that amount rather than include it in your expenditure methods. This alone reduces your borrowing power by about $40,000 in comparison to a different type of financing arrangement. If you got a personal loan, for example, on that car, you'll have a $40,000 boost compared to getting a car loan. Now, the best circumstance here is actually just paying cash. Don't take out non-deductible debt like bad debt to go and buy a car because it's going to damage your borrowing power when you go purchase a home. But if you do, avoid car leases because they're the worst of them all. And number 8, this one's my favorite one. What does the impact of children have on your borrowing power? Now, this is a little bit different and it does scale a little bit. The first child you have greater expenses associated with that, a little bit more, so it reduces your borrowing power by about $60,000 to $70,000. Each additional child is about a $50,000 drop to your borrowing power. That's because, children have expenses attached to them, it increases the minimum expense banks take, and as a result, you have less leftover income every month to go and repay your loans, and that reduces your borrowing power. Now, we find that most of the time when people have children, it's actually not the expense part that actually drives their borrowing power reduction. Quite often there's an income reduction, someone has to go back part-time or they choose to, or someone's not working at all. And that can have a big, big impact on your borrowing power. Now, the initial bit of income you earn gets more than a 7.5 times multiplier because it's tax-free. So you might get a 10 times multiplier on that income, the first $20,000, $30,000, and then the middle income that you get is about 7.5 times, while income above the $200,000 band, that's going to get a slightly lower multiple than that 7.5 that I talked about. So there you have it, a few golden rules to help you understand your finances and help you grow a property portfolio. If you enjoyed this video, hit that subscribe button and I'll come up with more unique and interesting finance content for you all.